Okay, so where this will be module 3 for our MBA finance course. We're going to talk about the basics of rate of return, payback. We're going to talk about the internal rate of return for a project. We're going to talk about choosing capital investments when you have to limit your choices. You can only choose one or the other, right? How do you pick which one? Then we're going to start talking about net present value, corporate income taxes. We're going to have an example that we work through, and then we're going to use NPV, the net present value rule, to choose among projects, right? And so we're going to look at a few different examples, but it's all going to be using that NPV rule. Okay, so when you think about what a company does, right, and how all this works, the cash will come into the financial manager, right? They can then use that to invest in other projects, right? Or they can take the money and pay it out to shareholders. Those shareholders could then invest on their own, right? So either way, either we invest it within the company or we pay it out as a dividend, and then shareholders have an opportunity to invest on their own. But regardless of who's making the investment decision, we're going to see that we would use the same different way to approach which projects are best, which ones will give us the highest return. Okay. As we're going through here, here are the points to remember about net present value. I'll let you read those on your own, but the truism at the bottom, the net present value of A plus B is equal to the net present value of A plus the net present value of B, right? We can separate out the cash flows and look at those independently, which it helps us sometimes when we're comparing multiple projects. If you look here, you'll see they've asked CFOs, what do you do to evaluate how which project to choose? And as you see, the IRR, that's the internal rate of return, and the NPV, net present value, overwhelmingly are used. Payback we'll get into, but payback is basically how long it takes to recover your initial investment. And as you can see, that's a pretty big or often used one. You notice the book rate of return, not nearly as well used, and then profitability is also not very well used. Not to say that they're not useful in some scenarios, just that they are not being used by the CFOs that were in this particular survey. Okay, so that book rate of return, like we said, that's not used as widely, right? But basically, you look at the book income and the book assets. We tend to not use this one because we have access to better data, right? And we would rather use things that show what's really going on instead of these reported numbers. Now, this could be used perhaps if you're looking as an external person and you're just trying to get a sense for that, because they do have quoted numbers, right, from their books, right? The 10K and the 10Q that get released would have that information. And then the issue around payback is basically that we would sit there and look at how long it takes. So if I pay $5,000 and I'm going to receive $800 a year, then after 6 years, I would have received 4,800, and then in that 7th year, I'll receive the 200 back. And is 6 years plus a little more acceptable? Well, that is determined by whether or not my time frame is longer or shorter than that, right? But we're only looking to see how long it takes for us to get that initial investment back, which ignores the time value of money, right? And it also means that once we reach the payback decision or not, we've made that decision, and so it's going to ignore all cash flows beyond that payback time period. So just to look through this one for a moment on your own, and then I'm going to go on to show you the next one. Feel free to just pause the video to see um, what you would choose. Okay. Now with the internal rate of return, this is going to be determining what discount rate would make the NPV of that project equal to 0. So as we increase our discount rate, the net present value of those cash flows go down, and it'll reach a point where it actually reaches 0. Now, if it were already negative, right, we know that we don't want to do a negative NPV project because that's going to destroy value for the shareholders, right? But as far as the any positive NPV project, we know that there would be some interest rate where that NPV would fall to 0, and that's the IRR. Okay. And so you see below that the internal rate of return rule, right? So using the rate of return and then the payoff and investment of this project. So we're going to use an example, right, where you are going to make an initial purchase of 4,000. So minus 4,000, you're going to pay this out, and then it's going to generate $2,000 and then $4,000, right? And then we would say, what is the IRR of this investment? So what is the discount rate that would make this NPV equal to 0? So when you write it out as a formula, right, this is what you get. Now, you'd have to do a good bit of algebra, right, to include doing the quadratic formula in this one, but you can solve for that IRR. But we're going to do these on the calculator, maybe use Excel. So you're not going to be trying to solve this one by hand, but just so you understand mathematically what's going on, the IRR of 28.08 would make that entire equation equal 0. Graphically, this is what that looks like. So as the interest rate goes up, that's that x-axis going from 0 up to 100% discount rate, right? And you notice the net present value falls from $2,000 through 0, and it continues to fall, right? And so in our case, we would say, hey, if the interest rate is above that 28%, then obviously it's a bad project. But if it's less than that, then this project will generate a positive NPV, and therefore it will increase the value of the firm. Okay. Here's just a few issues that can come up with this. So the first one is the fact that lending and borrowing rates tend to be different, right? And because of that, we won't necessarily have accurate representation with our cash flows, right? Because it will be different. You can have multiple IRRs. So when this happens, when you have multiple changes in the direction of cash flow, so maybe it's a negative payment to begin with, and then you earn some positive cash flow, then there's a negative cash flow when you refurbish something, and then there's a positive cash flow. When you have that, then your NPV gets more complicated, begins to look more like a polynomial, and therefore you're going to have multiple times when it can cross 0, right? And so that can sometimes make it a bit challenging to determine, right? This is an example where it have positive and negative cash flows. So it changes direction. And this one, it's not able to calculate an IRR at all, but we do have a positive NPV at some interest rate. Okay. Also, we need to be careful of mutually exclusive projects. Sometimes you can only do one thing or another, or you may just have a budget big enough for so many projects, There may be a limit to the number of projects, even if they're not very expensive, just because of how much time they take up. So any sort of constraint like that is going to be an issue when we're trying to evaluate which projects to do, right? And so in this one, you notice, we got these two different cash flows, and if we were to graph those, you see those two projects look very different. And so depending on what our interest rate is, project G looks better at really low interest rates, and then it crosses over to some point where project F looks better, but then there reaches a point where you would not want to do either. And so that's can be very complicated to look at using these methods. And then we talk about the opportunity cost of capital. That's how much we're giving up to use capital in this way. So we could have had the funds doing something else, right? But then there's a lot of assumptions that go into it, and those are listed there just to think about. There are a lot of things that we do when we're making these types of capital decisions that may not be valid assumptions. Okay, so what about when your resources are limited? What do we do, right? Capital rationing is a big one. Soft rationing tends to be where the limit is there because it's set within the firm. Like, we just don't allow any projects over $1 million without it going through some other process, right? Where hard rationing would be like, look, we just can't borrow the money to do this, right? So there is no, I cannot squeeze blood from a turnip or blood from a stone, or those sayings. I just cannot get additional capital. Where soft rationing was the firm itself was like, well, we're just not going to allow you to spend that much. And so this is an example problem that we're going to go through in capital rationing, right? And so we're going to look at the profitability index. Again, we talked about whether or not CFOs are using that profitability index, and not many do, but we'll talk through it, and you can see maybe it can be a useful tool depending on what types of projects you're evaluating, right? So let's here's some examples. So projects A, B, and C, and you see how much we invest and what the NPV of the projects is. Simply taking the NPV and dividing by the investment, that gives you the profitability index, right? So you notice the 2.1, 3.2, 2.4, right? So often in a case like that, you would say, hey, let's go with the highest profitability, right? But there can always be other constraints there. And also just this probability it purposefully ignores the magnitude, right? We do this just to see how many times you make back the investment. But one of those projects is as big as the other two combined, right? And so we have to remember we need to consider the magnitude. Right. So so if you only have 300,000 to invest, right? How do you choose these, right? And so we have projects A through D. They all have their NPV, right? And they all have their investment, and the sum of the investment could not exceed the 300,000, right? And so one example would be, well, let's use that profitability index, but we could weight that, right? Based on these projects. Okay. And then once we get that weighted average, we can go back and look at how these compare to that. And select the projects that have the highest weighted average profitability index, right? Which in this case, B and C have the highest, right? That would be the projects that would give you the highest return for your investment, right? Knowing that, like if I do project A, I can only do A, right? And then I cannot invest in other projects where I could do B and C or B and D, but C and D cannot. I can't afford to do those two together either, right? So, but yeah, so that's how you would select projects using probability index. But as we saw, it's not used as much, but who's to know going forward what you may find more useful. Okay. But we did see that a lot of them use net present value and IRR. And so let's focus on net present value at first. And these are just a few, or a way of thinking of this rule, right? You discount the cash flow, you don't discount the profits. And so we have to remember that we do a lot of things in accounting that will change the profitability, but those don't affect the actual amount of cash coming into the firm. And so that's what we're trying to focus on is are those cash flows. Okay. And then the working capital, this comes up a lot because as we're making these changes in projects, we may need to make changes within our working capital to better fund those. And we have to make sure we properly account for that as well. So, first we wanted to make that discount to the cash flows. Now we're going to talk about discounting incremental cash flows. So all incidental effects. Don't confuse the average with the incremental payoff, right? The average payoff versus the small change due to making this other change, right? That's what we mean by the incremental. We forecast the product sales today, but we also have to understand after sales cash flows, right? Because we understand that those cash flows are what we're really worried about in making this decision. We have to include the opportunity cost, but we have to ignore sunk costs, right? So opportunity costs are things that we give up by doing this. Sunk costs are things we've already paid for. So it doesn't matter, this one way or the other, it's already paid for, right? So whether or not I use that truck doesn't matter. The truck's already paid for. Okay. And then it says beware of allocated overhead costs. Just understand that sometimes overhead gets split out over several projects, and we have to understand how that's being split and make sure it is representing what we're actually doing, right? Maybe we're not using the equipment the same way, and therefore maybe we shouldn't have the same overhead assigned to us as someone else. So we need to make sure that the activity-based costing is reporting this properly. We also need to remember that there is a salvage value to most of our equipment. And so we need to make sure when we're calculating net present value, we remember this salvage value at the end of the project. Okay, so our third rule, we're going to be consistent in how we treat inflation. So I'll let you read through that, but yeah, we just want to make sure we're consistent. So we can do nominal, we can do real, but let's just be consistent. Okay, and this has come up before, but the Fisher equation, 1 plus real times 1 plus inflation is equal to 1 plus nominal. But we can rewrite that just real equals 1 plus nominal divided by 1 plus inflation, and then all of that minus 1. And so if you take, we've got those cash flows of minus 100 immediately, and then we'll receive 35, receive 50, and receive 30. Discount that back at 15%. What is this project's NPV? $5, $5.50. Okay, here's another project or Now the project's got the same cash flows, but it says, what if the nominal is 15 and then the inflation rate is 10%? What is your NPV of the project, right? So now we have to figure out what our real discount rate is, right, using that nominal and inflation, and then we will calculate what our value is. All right, and then rule 4, right? We want to separate investment decisions and financing decisions. Okay. And then the fifth rule is, we're doing this, we have to remember our taxes, right? Taxes will be important throughout this course, and that's just because it influences our decision, because the taxes will shelter, or some income will be sheltered from taxes due to some of our financing decisions, right? So we want to make sure that we're very careful about that. This just shows examples of what corporate tax rates are like across a lot of economies. And this is recent Job Cuts and Jobs Act, Tax Cuts and Jobs Act. And so you see the changes that it made, not just in U.S. tax rates, but also how we handle depreciation, right? And this was to spur R&D, and so they're allowed to basically take expense a lot of things that instead of depreciating it. And so by writing it all off immediately, you're able to take that tax shield. So that was a change. Also other changes within R&D as expenses, and then this tax carry forward. So you're not going to be allowed to carry things back, but you can always carry forward losses, right? And so that would allow you to continue to work on projects and incur losses, knowing that you'll have this big tax shield in the future. And so it may seem unusual, you know, make these changes, but really it did a lot of things to try to spur innovation. That was sort of the idea. That's how the tax code was used. Okay, they did make some limits on interest deductions. And so this is basically to tighten up a lot of those shields. But it's not something that affects most companies, but there was a certain way of structuring yourself, taking on a lot of tax shield to really drive a lot of sheltering. So they just tightened up some of those issues. And then we switched to the territorial system on taxation. So we used to tax all income, but now we've changed it to the territorial system. So we don't tax Google on the money they make in Australia. Australia taxes them on that. Okay. So as we look at a project, right, we know that we're going to have to pay out initially, right, this capital investment. So anything that we have to buy, and then we're going to receive an operating cash flow, right? So we're going to have some sort of increase in sales, and then we're going to have a cash flow from the changes in working capital. Okay, so let me kind of talk through that. So if you are adding this new widget that you're selling, okay, you're going to have to pay up front to start acquiring that. So either you're researching how to make it and buying the equipment to do it, or you found somebody to supply you with what you need. But all of those expenses is that capital investment up front. Okay, so I bought my machine that spits out my widgets, right? For the operating cash flow, I'm going to say, okay, I am selling 100 widgets a day and they cost $5, so it will generate $500 a day, right? It doesn't change my other, right? This is just the increase in sales revenue from this new thing, right? So that when I'm trying to evaluate the project, I want to compare it to if I had not done the project, right? So I'm just looking at this incremental change in cash flow. Okay. And then the change in working capital, well, maybe now because of this widget, I have to keep certain spares on hand, right? Or something like that. And so by needing to have like these types of supplies, I would have this negative cash flow because I got to buy that and then it just sits in a drawer. Now, you can have the working capital be positive, but that would be like when the project terminates and you get to sell all your extra supplies. Then your net your working capital will change, right? Your net working capital will be lower, and so that would be a positive cash flow, right? But if net working capital goes up, then you paid for that, so your cash flow must have gone down, right? Because the cash paid for your increase in working capital. I'm not going to obviously read all this, but we're gonna kind of go through a bit. So I just wanted you to be able to look at these charts, and then I'm going to slide through it. So just pause as you need them. Okay. And so now that we can talk about a little bit now that you sort of seen what we're going to talk about. So we're looking at what is the difference in if we're able to do just a regular straight line depreciation like what we normally teach in accounting versus having that immediate expense, right? If you see in this one at the bottom, 19 NPV, the NPV of these cash flows with that depreciation over the years ends up being 3,806. And then if we expense it immediately, you see it jumps up to 4,929, right? So yeah, telling companies that they could immediately expense, if you see up there on line 8, depreciation shows us 12,000 in year 0 and then 0 for the rest of the time. Just being able to accelerate that all the way up to the present drives a lot of that net present value, right? It really causes it to increase. So that's when they made those changes in the tax laws. Suddenly, some of these projects look so much better, right? And so it's a way of spurring more investment, right? Because you're going to have more projects to invest in, right? And so when you think about U.S. tax policy, don't think of it as a way of raising money. That's not why the government's doing it. We print the money we spend. When we're doing tax policy, a lot of times it's because we're trying to drive activity one direction or another. This investment timing decision, I'm going to have an example to look at, but this is basically just looking at when would be the best time to do a particular project, right? And so in this particular case, you're growing timber out somewhere. The longer you let it grow, right, the more you're going to have to pay to have it taken, right? But your trees are growing, right? So they're getting bigger and bigger, right? Kind of a way to think of it. And so you have to decide when is the best time to harvest, given that you have these tree values, which let's just assume you can ascertain what that should be, and then a 10% discount rate. When is the best year to harvest? And the answer is in year 4, right? If you look at that year of harvest, 4 is 68.3 thousand. That's the highest, right? So the best thing to do would be to wait till year 4, and that's the optimal growing, amount before harvest. Okay, so here's another thing to look at. Is it better to have something that lasts longer, or something that doesn't last as long, right? So what we try to do is think of it as a cash flow, an annual cash flow, right? So we'll use an example, right? These are the costs of two machines. So they're not generating revenue. They only cost us money, but this happens. They're called cost centers, right? And not everything generates money within the company, but they're all parts that we need. So we've got these two different machines, right? 6% cost of capital. Which machine has the lower equivalent annual cost? Right. So you see here, machine B is 21, machine A is 28, right? So machine B, just look at the cash flow, you might be like, well, it costs a lot and we wear it out quick, but it actually ends up being less, when you're using that particular cost of financing, right? It would be different with different costs of capital. Okay. When to replace an old machine. So again, we have this machine that currently exists and it's got this cost structure, right? Or we can replace it with something now that's going to cost a lot more. And is it better to, well, we know we're going to have to replace it. Is it better to do it now or to wait a year? Right. And so you'll see how that new machine looks, right? And then you can calculate what the equivalent annual cash flow, right, would be to equal that net present value. Okay. What about when you have excess capacity, right? So a computer system costs 500,000 to buy and operate, and it lasts 5 years, right? So if you were to wait, right, until year 4, right, then you could see that the annual cost is 118,700, for that $500,000 investment. But if you just waited to year 4, it'll be 94,000, because you're paying for all of this, computing power that you don't necessarily need. And so that's what you're looking at. Is it worth having that excess capacity? All right, and then that will conclude module 3 for the MBA Finance.